All right, just wait another minute or so. Lots of people coming in. All right, so we definitely see you all coming in. Thank you so much for joining us. We'll go ahead and get started right away so we have plenty of time for questions. Again, hello everyone. My name is Elizabeth Anderson, and I am a member of the Generational Engagement Team here in Development and Alumni Relations at BU. Welcome, and thank you for joining us today for our Figuring Out Finance, Personal Finance 101 webinar. The Boston University Alumni Association and the BU Young Alumni Council are sponsoring today's webinar and are so happy that you are here. We appreciate everyone who's joined us. Today's event is intended to help you continue building skills and knowledge to navigate life after BU with confidence. And as I said, we're sponsored by the BU Young Alumni Council. The BUYC exists to strengthen the engagement of young alumni by fostering a vibrant global community and of individuals who maintain an ever-evolving and lifelong relationship with Boston University and each other. This program is one of the many opportunities that BU provides to inform and enrich your alumni experience, and we hope you enjoy today's presentation. Before diving in, just a few housekeeping notes. Today's presentation is being recorded and will soon be available for on-demand viewing on the Alumni and Friends website, which can be found at www.bu.edu/alumni. Any questions that were submitted during the registration were shared with our speaker and host ahead of time, and they will make every effort to answer them throughout the webinar. For any question that is not covered in the presentation, you're encouraged to submit it throughout tonight's webinar using the Q&A function. Today's speaker, Mitch Tuchman, is the Managing Director of Rebalance, a Forbes Top 250 Advisors firm and winner of the Schwab Pacesetter Impact Award. Mitch graduated from Boston University with a BS and earned his MBA from Harvard Business School. He spent the first half of his career as a Silicon Valley software entrepreneur before entering investment management with Apex Capital LLC, where he oversaw a $200 million technology portfolio, co-managed its venture capital fund, and served as director of 4 NASDAQ companies as an activist investor. His experience pioneering America's first online investment advisory service led him to co-found Rebalance in 2012. Mitch is a frequent guest on CNBC, PBS Wealth Track, and Consuelo Mac, as well as CNN, and is also regularly featured in major financial publications, including the New York Times, the Wall Street Journal. Thank you so very much for being here with us today, Mitch. We are very, very glad to welcome you as our alumni host.
Well, thank you. Thank you. It's a pleasure to be here, and especially speaking to a BU audience. I was there. It was a long, long time ago. And I know the slide says the Questrom School of Business, but that's back in my day, it was just called SMG School of Management. So that shows how long my shelf life is. Anyway, what I want to do, though, is really introduce my esteemed associate, Matt Jude, who's really going to be speaking with you today. Matt's on here on the video with me. Matt's been with Rebalance a couple of years now, and he graduated Cal Poly, which is a wonderful school out here in California, and also UC Berkeley in counseling and psychology. Matt also was a D1 swimmer at Cal Poly, and then got into our business right out of school, and over the years has earned many of the really important credentials that he'll talk more about with you in terms of being good at our business, particularly being a financial planner. So Matt, just wave so they all see you there. There we go. All right. So Matt's really going to be presenting the material, and then the two of us will spend some time on Q&A. Just a little bit about our firm. We are a wealth management firm. We're based out here in Silicon Valley, Palo Alto, where I live. We began the business because I personally was a software entrepreneur who made money in the .com, and I ended up getting into this business because I wanted to learn how to manage my own money and had an opportunity to do that. But over the years, I had a lot of friends and family ask me what I thought of their portfolios. And I realized that Wall Street, as we knew it back in the day, I began to see as one of the largest wealth siphoning machines in the world. It was astounding to me. And I wanted to do something about it. And so my good friend from Harvard Business School, Scott Puritz, we teamed up and started Rebalance. And that was we launched it about 11 years ago. Today we manage over $1.3 billion. And what we did is we put this really cool investment committee that does investing like endowments and foundations to bring that to everybody, everyday investors. And a lot of what we're going to be talking to you about today is how that endowment model works. And it's really interesting that now anybody can invest like the largest investors in the world. We've done a lot of work to head pro-consumer efforts for investors because there's a lot of stuff that goes on in this business that's less than above board. And we have a team of certified financial planners. So just really quickly, we've won a bunch of awards. We're one of the largest firms now in Silicon Valley. We got a great award from Forbes. It's one of the largest, most top firms in the country. And then we have an investment committee. One of the heart and soul of our firm is we brought together some of the smartest people who manage large pools of money or are involved in large pools of money, and said to them, help us manage everyday investors' money using the same strategies you use. So we have Charlie Ellis, who oversaw the Yale Endowment, Burt Malkiel, who wrote a book, and we're going to talk about that in a minute. That's a classic. It came out when I was at BU, as a matter of fact, and just celebrated its 50th edition, 50th year, 13th edition. It's still highly relevant. Anyway, this is our investment committee. They're great folks. They've helped us quite a bit. And we've been in the news a lot because we're doing something very special and unique to what's going on in financial services today. One reason we've been asked to come to BU is, we're really not here to sell anything. We're just here to enlighten and show you some things that might give you an aha moment. And for those of you younger, might even change the course of your investing life. And maybe 40 years from now, you'll look back and say, this webinar was a seminal moment that gave you some information that was life-changing for you, because that's really our goal. A couple little things about this webinar. Please submit your questions via the Q&A, not the chat. And we did get a bunch of questions that we will weave into this presentation. Matt will talk about that in a moment. So that'll be helpful for us to see what you're thinking. And then I mentioned this book called A Random Walk Down Wall Street by Professor Burt Malkiel. Burt's on our investment committee. Burt has been called a national treasure by people in the finance business. He wrote this book in 1973. It became a bestseller. It sold nearly 2 million copies. It's probably the most significant book ever written in personal finance in the history of this country. And it's just a wonderful book. And if you give us, there's a form in the chat box. If you click on the chat box, you'll see a Google form. And if you put your name and address in there, we are going to give away 10 copies of this book. So there's a lot of you who signed up for this webinar, but there'll be plenty of books to go around. And this book is really amazing. If you look it up, you'll learn more about it. But please sign up for the raffle and hope you get one of the books. Also, if you like this webinar, we're going to give you some suggestions on how to keep learning. And that's part of our strategy as a firm. But let me just give you one big idea that may be the most important idea, that if you can remember one thing, don't forget this. Money makes money. The more money that you have, the more money that money will earn. And then what you earned on the money, that continues to make money. It's called compounding. It's like if you start off with a little snowball and you start pushing it in the snow down a hill, it attracts more snow. And then as it continues to roll, the snow attracts more snow. And by the end of the run down the hill, a little snowball turned into a boulder. that's what happens with money, people. The earlier you start and the higher rate of money your return is, you will end up with an astounding amount of money. So just to have you understand this law of compounding, Emma attends this webinar and she starts investing right away, 500 bucks a month this month. And Olivia waits 5 years. In 35 years, Emma will have $1.146 million and Olivia barely $750,000. That is the power of this. And we haven't even talked about rates of compounding, which has a big impact on this. So remember, money makes money if you let it grow and compound. And with that, I will turn this over to you, Matt. Go for it.
Thanks so much, Mitch, for getting us started there. Yeah, hopefully we can give you all some good tips on how to get started with compounding. Today we're talking personal finance 101. We're trying to provide you with some guidelines for anyone who's getting started with budgeting and saving for retirement. We're trying to get you comfortable with some terminology, talking about money, like this type of account versus that type of account. We want to give you some next steps and tools to take with you. And most importantly, we want to answer your questions. So again, like Elizabeth mentioned, we received the questions ahead of time, and hopefully most of them are covered in this material. I think most of them are. You all asked some great questions. If there's anything that you want clarification on or that we don't cover, please submit it, like Mitch and Elizabeth said, through the Q&A function. I'm going to be going pretty quickly. We have a lot of content here. So if it's too fast, let us know. You can send something in the Q&A if I go over something too quickly. So let's get started here. Our first topic is budgeting. Budgeting is all about tracking and categorizing your income, your spending, and your savings. How do you do that? There's a great rule called the 50-15-5 rule for budgeting. And these percentages in this pie chart help you determine how much of your money, how much of your income you should allocate to these different categories. So you want to fill up these buckets. I'm going to start down here at the 15, the 5 and 15. So 5% of your income, this is net income that I'm talking about for this piece. So the after-tax actual deposit that you get from your paycheck, in your checking account. That's what you want to use when you're calculating the 5%. You want to put that toward short-term savings. So that's to help build up an emergency fund and cover specific financial goals that are usually in the short term. 15% you want to have for long-term retirement growth. And 50%, this is kind of a max threshold. You want to keep your essential living expenses at or below 50% of your net income. This retirement piece, you'll see the 15%, we're kind of talking about your pre-tax salary. I'll get into some more of the details, but these two, you're looking at the direct deposit in your bank account, in your checking account. And then whatever money you have left over is for all of your other expenses. Okay, so we'll get into each of these categories a little bit more. Essential expenses, some of the most obvious ones are, of course, housing, food, and that's like essential food, not DoorDash or restaurants and bars. Debt payments, especially mortgage, or if you have student loans that you're paying down, transportation, healthcare, childcare, all that good stuff. 15% is going to be going toward long-term retirement savings. This includes employer contributions. So let's say you have a 401k through your employer, and there's a match feature on there where your employer says, okay, if you put 6% of your salary each year into your 401k, we'll do 3%. You get to count that toward the 15% total. Okay. So, and if maybe you're new to employer match or 401ks, so I'll give an example of one. Sometimes how they're configured is the employer will do 50%, they'll match 50% of your contribution up to 3% of your salary, for example. So in order for you to get the maximum match, you'd have to contribute 6% of your salary. Following, so you do 6, employer does half of that up to a max of 3. So 6 and 3, you come up with 9% that's going toward your 401k. That doesn't get up to this 15% total, but I just wanted to illustrate how the match works. A big tip here is automatic increase of contribution. So if you're just getting started and you're like, I can't do 10% or even 6%, a lot of 401ks will have a feature on there where you say, I want to start at 2 or 3% and have it automatically increase each year. And so it'll bump you up to maybe about like 1% per year. And that just kind of puts it on autopilot for you. 5% of your take-home pay should be going toward short-term savings. This, again, is like an emergency fund, which we'll talk a little bit more about, or one-off expenses, like you have a specific goal, maybe a down payment for a home. Another tip here is automatic deposits or transfers. For example, like from your checking account to maybe a high yield savings account, you can set it up so that each month after your paycheck comes in, you have it just going into your emergency fund account. And it can help to have like separate accounts for those things so that you can account for the purpose of each one. So everything else, these are the fun stuff, your discretionary expenses, streaming services. These are where maybe you can, when you start budgeting, you might realize you're spending more than 30% here, and you need to find ways to increase the other categories. Discretionary is typically where you're going to be trimming some expenses if you can. All right, I mentioned we would talk more about emergency fund. What you're aiming for in this account is somewhere around 3 to 6 months worth of your expenses. That's the balance you want to try to reach in an emergency fund. It's a general rule of thumb, and it's basically to cover, it's to protect you against 2 things. One, unexpected spending. So like if your car breaks down or your home needs a repair. And then the other thing it helps protect you against is unexpected loss of income if you lose your job or your hours get cut. Again, autosave is a great tool here. This is a very high priority item. Again, emergencies, you don't want to get yourself into trouble if unexpected financial challenges come up. And that's what this can help protect you against. High yield savings account, we have a great interest rate environment right now for folks who are, if you're saving, not necessarily if you're maybe trying to buy a home. It's tough that rates are so high right now, but with where they're at, you can get a decent return in a high yield savings account. So it's good to have this somewhere other than checking. And again, this is a high level rule, the 50-15-5. It's meant to be memorable and easy, like you can write it on a sticky note. And but it's going to be different for everybody, like what your exact specific plan is. That's kind of just dependent on what your goals are. So it's a great starting point though. If you have, again, a goal like you want to take a trip or you have a wedding, a house down payment, it's okay to change these percentages and slow down on the 15% long-term retirement savings for a little bit to accomplish those other goals, as long as you get back on track for the long term. And also high interest rate debt. And we'll talk about prioritizing. There's another really good slide with that. But some of you might have like credit card debt or student loan debt that's not in deferral or not subsidized. That can sort of increase the priority for paying it down. So here's your first set of tools. These are some great resources. We're not gonna like click into them all or any of them right now, but they're hyperlinked for you, and everyone's gonna get the slides. So you'll be able to check these out on your own. This is a tool from Fidelity, and Fidelity's big on this 50-15-5 rule. They've done a bunch of research on it, and you can go in there and check for yourself to see if you're on track. FINRA has a nice, you can find these retirement income calculators all over the internet, but this is a good unbiased one. FINRA is a regulatory authority in our world, and it just, that can help you figure out how much in dollars you need to be deferring to accomplish your retirement goals. Notion, you are all probably young and tech savvy and can take a look at this and figure out what it's all about. It's more than just budgeting. This tool, this software, it's online and it just has a bunch of stuff you can do, but there's a great budgeting tool in there that I think takes a little bit of work on your end, but check that out. It's free. Google Sheets, very straightforward. You know, we have a couple of templates here that you can check out. Really, anything that you can do to see your expenses, see where you're spending money, and find ways to eliminate things. Like, I don't know, you might find you have a streaming service that you forgot about. Like, you signed up for Peacock to watch some show and then forgot about it after a year. So you might find ways to cut by just looking at things in the spreadsheet. And then if you want to pay for something that's a little bit better service, Monarch Money and You Need a Budget Now are a couple of options. There are tons out there. Monarch is vetted. I've used that one, and I just think it has a great user interface. It's like $100 a year, and I think it's worth it if you want to see what your spending looks like. Okay, our next big category is saving. You're setting aside money for the long term and the short term. Okay, this is all about drilling into the 15% and the 5%. So we're going to talk about different types of accounts and how you can use them to help you save. Take a look at this savings and investment landscape. I talked about 401k a little bit. We'll talk about it some more. You might recognize some of these accounts. Maybe some of you have a Roth, a money market, checking, whatever it is. We'll talk about actually most or all of these. And I think that's quite a few of the questions before the event were kind of about this, like these different types of accounts. So first, short-term saving. This is about the 5% portion, right? Your emergency fund and short-term goals. On the y-axis here, we have rate of annual percentage rate or return. And then down here is liquidity, which is basically how easy is it to get your money out of the vehicle. And we have CDs, money markets, savings, checking. Basically, this is showing the easier it is to get your money out, so that the higher the liquidity, the less it pays in interest. General rule of thumb there. So for an emergency fund, you want to be able to get the money out of there. You probably don't want to use CDs. CDs aren't bad. They have a good purpose, but for something that you might unexpectedly need to tap, you probably want like a money market account or a high yield savings. CDs, they can have early withdrawal penalties. So that's the drawback there. And here's some more information on savings, money market, and CDs. Again, a lot of it is about the trade-off between ease of access and what kind of interest rate you earn. So I mentioned before that I was going to show something about like prioritizing the different buckets and your saving. This is an awesome visual. I love this. It's like you just you really want to, in general, go in this direction. Again, that 401k match, make sure you take advantage of that if you have it. Otherwise, you're leaving money on the table. High interest debt, credit card interest rates are crazy right now. 6% is kind of a good figure. If it's anything above that, that's where we start to say, like, aggressively attack it. HSAs, they have this great triple tax benefit. The first one is you get a tax deduction when you make a contribution to the account. Second, you get tax deferred earnings, and often you can invest within an HSA. And then third, you get tax-free withdrawals for qualified medical expenses. So there aren't many, it's like the only account that has all three of those. Usually you're getting taxed somewhere along the way. If you take money out of it though, and it's not for qualified medical expenses, there's a 20% penalty. However, when you turn 65, you can take money out of it. It kind of works like an IRA. When you're 65, you'll pay some ordinary income taxes, but you won't have a penalty. So it's great to max that out if you can. Then you can add to your 401k. Some of you might not have a 401k, and an IRA is a good idea. And a taxable brokerage account, which is basically means the investment earnings in that account are taxed along the way as they're earned. So if you get dividends, you're getting taxed every year on that. And then if you can get totally debt free, like if you still have money left over at the end of all this, then I don't know, you probably don't even need to be on this webinar. You're going to be in pretty good shape. But if you can be totally debt free, that's great. It frees up cash flow for you. Okay, so I talked about HSA a little bit. Some of you might have heard of an FSA. These two account types, health savings account and flexible spending account, are similar in that they both have tax advantages and are related to healthcare expenses, and they can both be part of an employee benefits package. However, there are some really significant differences. An HSA is really just tied to your insurance plan. Okay, you have to have a high deductible insurance plan. It can be on your own or through your employer. It doesn't matter. You just have to have a plan that meets the specifications. An FSA is tied to the employer. That's how they're offered. It works with an employer healthcare plan, and you can't just go out and get one on your own. The biggest difference between these two accounts is that an FSA is use it or lose it. So if you make your annual contribution to an FSA and say you add like $3,000, and then you use $500 this year on healthcare expenses, when 2025 hits, the balance is gone. Like, you forfeit it. Sometimes there's a rollover feature where maybe $500 you get to keep, but for the most part, you lose access to that money. Whereas an HSA is your account. You keep it forever, and there's no concern about whether it rolls over into the next year. These accounts, I think a lot of the questions really that we got were asking about 401ks and traditional versus Roth. So we have two types of IRA, traditional and Roth IRA, and then two types of 401k, traditional and Roth. These all have tax benefits one way or another. They all have some restrictions and rules that you have to follow per the IRS tax code, and there are advantages and disadvantages. High level, the difference between traditional and Roth is when you're taxed. So a traditional IRA and a traditional 401k have tax deductible contributions. You defer $10,000 into your 401k. That $10,000 is not taxed when you earn it and make that contribution. It's taxed when you withdraw it from your 401k, like in retirement. A Roth, on the other hand, you are taking after-tax dollars and making contributions with after-tax dollars. They, both traditional and Roth, will grow tax deferred, meaning as dividends and interest are earned in the accounts, you don't owe income taxes on those. But the Roth, since you paid taxes up front on your contribution, you do not have to pay taxes when you withdraw. And so like, why would you pay taxes now if you don't have to? If you are early in your careers, which a lot of you may be, and you expect your income to increase over the next 5 to 20 years, then you're probably in a lower tax bracket right now, and you might benefit from doing Roth contributions and just take the tax hit now while your tax bracket isn't too high. For folks who are in their highest earning years and up in those higher tax brackets, maybe 35%, then you're looking for any avenue you can to get a tax deferral, and then traditional pre-tax is usually the way to do that. It's hard to get money out of these account, like 401k. It's harder to get your money out of there than you can from an IRA, either type, because of the restrictions and how they're set up with the companies. And there's early withdrawal penalties on all of these accounts. So before the age of 59 and a half, if you have to take money out of there, then you're going to have some penalty. And that's why that's why you want to have an emergency fund to tap if you need to. 401k match, I talked about this, so I think we're good on that, but send us a question if you're still wondering. It's free money, basically. It's leaving money on the table if you're not taking advantage of that. Okay, this is our last of the 3 big categories, investing, and this is all about what do you do within those accounts that we were just talking about, and how do you put your money to work for you. 2 worlds, banking and investing. You need to have both of these. You need to use both. You need to have a bank for your checking and savings and an investment company for your IRA or whatever type of investment account you have. A lot of institutions have both a banking and an investing arm. So you could probably do both at the same place if you want to. When you're investing, you're usually buying stocks and bonds. Stocks are ownership in a business. You're a shareholder if you buy a stock, and you make money as a shareholder when the company makes money and pays out a dividend. Bonds, you're lending your money. You're actually making a loan to the company when you buy a bond, and you're being paid interest. So stocks, again, you're paid by corporate earnings, dividend distributions, and also price appreciation. So if you have a share of Apple and corporate earnings are great and better than expected, the price of a share of Apple stock might go up, and then you have some extra return there if you sell the stock. So you get dividends, price appreciation. Bonds are not, the return you get from bonds is not driven by company earnings. It's determined by the interest rate that's set at the issuance of the bond. So you know what you're going to get paid. Stocks are much higher risk and therefore historically have pay a higher return. And bonds, there's still risk with investing in bonds. A company could go under, but less risk than with stocks, much less. Talking about risk, a great way to limit your risk is by using an index fund. And if you don't know what an index is, S&P 500 is a very common one that you've probably heard about or seen on news chyrons on the bottom of the screen. An index is a basket of securities. It's a hypothetical portfolio, and it represents some segment of the financial market. So sticking with the S&P 500, that is the 500 largest companies in the United States. But there are index funds for all different kinds of things, and a bunch of bond funds too, real estate, small cap US companies. And what they do is they provide you broad market exposure and diversification. So instead of just putting all your eggs in one basket and buying one stock or a handful of stocks, you can spread out your money across thousands of different companies. They're a great way to do passive investing, which is not thoughtless investing. It's basically just a way to get you invested in broad markets and not take huge bets by picking stocks. You're participating in broad economic growth by doing index investing. And there's some care that goes into which index funds to buy, which markets do you want to participate? And that's what we do here at Rebalance and other professionals out there. You can't just go and buy the S&P 500. You have to buy a fund that represents the S&P 500 or any other index. And so there are a couple of different packages that companies use to put those together: ETFs, exchange traded funds, and mutual funds. You may have heard of these. ETFs are usually preferred. They're kind of easier to buy and sell. They trade throughout the day on stock markets. There aren't any sales charges or purchase minimums that a mutual fund can often have. These two things aren't always created equally, though, the funds within these two categories. And ETFs usually have lower expense ratios. Okay, how do you pick between the stocks and bonds, and like what should your mix be? This is rule of thumb stuff here. It's not going to be true for everyone, but generally, the younger you are, the more you can have in stocks. You're going to have a higher expected return in the long term, and the volatility in the meantime is okay because you have time on your side. I have the next slide we're going to look at is kind of some more information on the risk reward trade-off and what does it actually look like? What does the volatility look like? So this piece, you gotta dial in on this one. There's so much going on, but I'm going to try to boil it down for you. First of all, we're looking at returns in a few different portfolios from 1950 to 2023. We have our color coding here. Stocks are orange, bonds are green, and a 60-40 portfolio, 60% stocks, 40% bonds in the blue. Annual average total return, a stock portfolio had the highest return, about double that of bonds, and the 60-40 mix was somewhere in between. So that's to be expected over a very long period of time. But what happens if you look at smaller segments within this 73 years? Okay, this part on the left is our 1 year intervals. So any 1 year along that timeline, stocks, the best year for stocks were up 47%. The worst year for stocks, down 39%. So huge upside, huge downside. Massive extremes there. The bonds, kind of crazy, 43% 1 year, down 13 was the worst year. And the 60-40 portfolio, a little bit less extreme. So this piece alone right here should show you why you should not put your money that you're going to use for like a down payment in a year in stocks, because you could have a year like this where it declines by almost 50%, and that's really painful. However, if we start to look at 5-year rolling periods along that timeline, any 5-year period in these 73 years, the downside is much, much less extreme. right? So the worst 5-year period for stocks down 3%, down 2% for bonds, the worst 5-year period. And 60-40 portfolio wasn't negative at any 5-year period. The 10-year rolling periods, no negatives for bonds, none for 60-40, and the worst 10-year for stocks down 1%. 20-year, there wasn't a single rolling 20-year period on this timeline that was negative for any of these portfolios. So the whole point is, as the time horizon expands, the downside is much less extreme if you can be invested through the volatile periods and get out to this longer time horizon. It's okay to have more in stocks. So a lot of you might be do-it-yourselfers and you're ready to just take some of this stuff and run with it. But for anyone who wants to seek a professional, there are a couple types that you're going to run into broadly: fiduciary and broker. Fiduciaries have a duty to operate in your best interest. It's a legal standard. It's a legal standard for that type of relationship. And a broker does not have the same legal standard. Their advice is in your, it has to be suitable for you. And often they'll prioritize commissions and sort of buying and selling stocks frequently. So if you're going to look for someone, just make sure what you can do is you can ask what the fee structure is for their relationship, and just ask them if your relationship will be held to a fiduciary standard. RIA, this is a registered investment advisor. That's the type of firm that Rebalance is. And broker dealer is often where you'll find the broker, the bad, who's operating on selling and generating commissions. Some firms out there are hybrid, RIA and broker dealer. They do both types of business. So again, just when you're interviewing professionals, ask so that you make sure you know what you're signing up for. Okay, what else can you do next? This is like, because that was a lot. I know we kind of powered through that, but we try to simplify it for you at the end here with a few tangible steps you can take. The first one is that 50-15-5 tool that I was talking about on Fidelity. Grab your phones, by the way, if you haven't. You can pull it up right now with the QR code if you want to take a look at that and see if you're on track. So I'll hang out here for a second. And we can probably pull this back up during Q&A too, if anyone misses it. The second thing you can do is make some of this stuff real by writing it down. Write down your financial goals. It's so easy to lose track of like what you want to do and where you want to be. It could be, buying a home is a common one, retiring at a certain age. Maybe you want to downshift to part-time work at age 50. Whatever it is, just make it real for yourself and put it on a piece of paper somewhere. Now, if you think you want to hire someone, you can talk to a financial advisor at an RIA. We have 500,000 here. This is speaking to investable assets or cash. And this is kind of ultimately whether you should work with a professional depends on how much complexity there is in your financial life. But this is what we've seen at Rebalance, is that on average, somewhere around $500,000 in assets is where it starts to make sense to hire a professional. If you are ready to just go set up an account, you can do that. we picked Vanguard here. You can open an account at Schwab or Fidelity, all kinds of institutions you can use. We put Vanguard on here because we use some of their investment funds. Vanguard really likes to keep costs down. We don't have any financial like affiliation with this. There's no, this is just, we think Vanguard's a good investment company. So you could go to their website. It's investor.vanguard.com. You can look at products and services, their investment products and their ETFs, that vehicle we were talking about earlier. And you can see their list of index funds on there. A popular one, this isn't like a recommendation to go buy this fund, but just a fund that you should know about that a lot of people use is Vanguard Total Stock Market ETF. VTI is the ticker symbol. And that you can see what it's like to just open an IRA or a taxable brokerage account and buy a share of something. Okay, and if you do, this is my disclaimer brain, but if you just be careful if you're setting up an IRA and you have a 401k, sometimes there are rules around whether or not you can contribute to both. So, if you want to just buy one share of something, maybe open a taxable brokerage account. You don't have to worry about that. All right, Mitch, I think you might have some lottery winners for us.
Well, we're not gonna announce them. It'll take too long because we did have enough names to give away our 10 books, but you'll be receiving an email from us, and then we'll send it to you via mail if you won the little lottery. So, and we want to get to the questions as well. So so I've been looking at the questions while you've been presenting, Matt, and I kind of have a few that kind of work together. So let me try to answer about 3 or 4 of them with one answer. Suzanne wrote in, can you move your money from a 401k to an IRA without penalty? The answer is yes, if you do that properly. Another anonymous attendee said, if you change jobs, how would you keep what you've earned through your 401k? It's the same answer. If you leave a job and you leave behind a 401k, what is best practice is to open up an IRA at another institution like Schwab or Vanguard and do a rollover, meaning move the money from your IRA over to that from the 401k and get it out of the company, because the company is likely charging fees. The investment options are highly restrictive, and you want to sort of get it out of there. So, and so that should answer maybe 3 of these questions. Matt, I'll throw one to you. What is a backdoor Roth IRA?
A backdoor Roth IRA is a way to, so Roth IRAs have income limits. Over a certain amount of income, you can't make a Roth IRA contribution. And a backdoor is a way of taking a traditional IRA and doing an after-tax contribution to it. So you're not getting that tax deduction that we talked about earlier. You put after-tax dollars into a traditional IRA, and then do a conversion. You can Roth convert your traditional IRA into your Roth IRA. So it's a roundabout way of being able to do a Roth contribution, essentially. The IRS, it's a commonly used tool. Just something to be careful of is if you have a traditional IRA with pre-tax dollars in there and you do a backdoor Roth IRA, the IRS is going to use this thing called the pro rata rule, which says that you're going to pay income taxes on a portion of that conversion. So usually if you have pre-tax, a normal traditional IRA, it usually doesn't make sense to try to do a backdoor Roth IRA with it.
Okay, I'm going to throw another one at you, Matt. Thoughts on day trading?
Yeah, we're not in the business of that, and it's because ultimately there's no crystal ball. There's it's just a good way to lose money fast. Now, whoever asked that, I hope you've done it and done very well. I know a lot of people out there have, but it's just not a reliable way of saving.
Yeah, yeah. That doesn't mean certain people don't make money day trading for certain periods of time.
Mhm.
But one of the things you always have to ask yourself when you hear about people making money is what risk did they take in order to make that money? Because we as finance professionals look at returns in the context of risk, the terminology being risk adjusted returns. So a day trader, depending on their strategy, they might have great trading, great returns, but too much risk. So anyway, here's one from Eunice, Matt. She asks, how much of my paycheck should be going into investing in stocks and bonds, and where does it fit into your 50, 15, and 5 rule?
Yeah, great question. So that fits in the 15% part. So stocks and bonds are long-term investments, and you have a couple different ways you can do that. Like if you have a 401k through work, that's one way. And if not, maybe an IRA or a taxable brokerage account. But yeah, good question. And that falls under the 15%.
Here's another good one for you, Matt. It's a little more personal to you. Can you talk about pursuing a CFP and the benefits it may provide for your career? I think somebody would like to know more about what you've done in your career and a little bit about that.
Yeah, that's great. Being a CFP is fun. It's so what you do is you have to have a bachelor's degree, and then you sign up for CFP courses. And CFP.net is the organization's website. There's some great info on there on how to get started. But yeah, you have to get through all the courses and then take ultimately an exam, long, arduous exam. But then you get to start working with folks, and you could do some different types of careers with a CFP designation. But what we do here at Rebalance, personal financial planning and wealth management and advice is kind of the main avenue for it. And I think it opens a lot of opportunities if you're interested in that type of work.
Great. Here's one from Quincy. This is a great question. Can you please talk a little bit about how a 403B compares to IRAs and 401ks? Maybe I'll just do that. Let me explain something, Quincy. All of these things like 401ks, IRAs, all that, these are what are called qualified accounts, meaning the government is saying, if you put money into them, there's a special tax treatment, and therefore they're regulated. So a 403B is really like a 401k. It's just a nonprofit. So if you work at a nonprofit, the retirement plan is going to be a 403B. If you work at a for-profit, which is more common, you get a 401k. In both cases, though, basically, let's say you make $100,000 a year. If you take $10,000 of that and put it into the plan, you only have to report that you made $90,000 in a year. So you're effectively not paying tax on $10,000. So to put the $10,000 into a 401k or 403b plan, the government's paying part of it because you otherwise would be paying taxes on that. But in all of these plans, whether they're 401k, 403b, which are sponsored by your employer, they're workplace oriented retirement plans, or whether they're an IRA that you control. I stands for individual retirement account. One day in a long period of time, when you get into your early 70s, you're forced to start taking that money out and paying taxes on it. So that's the big difference in all of these types of accounts. So that was a brief answer. Matt, I've had a few questions in here about trading platforms. Somebody asked about Acorn, somebody asked about Robinhood. Maybe give opinion about what a good platform might be for money management.
Yeah, I think as long as you have no fees on ETFs and stock trades, that's a great start. I mean, I would pick a platform that is more established generally. Usually that means more trustworthy. I don't know about Acorn. I've used Robinhood. I think it's great. And there's some, Schwab and Fidelity, the big brokerages, those have good tools as well, apps and everything. So I think as long as your fees are low, then it's okay.
Mm-hmm. Somebody is asking, if my company doesn't match my 401k, is an IRA better? What do you think of that one, Matt?
If my company doesn't match, is an IRA better?
Yeah, my 401k would it be better to have an
Yeah.
IRA?
That's a great question. Take a look at the 401k if you can, and see how broad your investment options are. Sometimes 401ks will be very limited on their investment options by the plan rules, and they can have higher fees. So I would look at that, and then I would also keep in mind that there are limitations on whether you can make a deductible contribution to an IRA if you have a 401k. So if you're making a lot of money, you might not even be able to make a deductible IRA contribution. You might just have to use the 401k.
Yeah, and when you have when you have a 401k, depending on your age, you can defer or put up to $30,000 if you're over 50, in the 20s if you're under 50, of your salary away. So if you're making enough money where you can save that, you have a lot more you can put away than in an IRA. The IRA is limited to about, I don't know, $6,500 a year.
So, yeah.
But if you don't
Yeah.
have either at work, it's better to just put it away in an IRA. We had a few questions about insurance, thoughts on life insurance. It's very hard to answer that question. It just depends what you might need it for. And then there's another one about where do insurance expenses fall? Matt, I don't know if you want to answer that one from Isabel. Where do
that's usually going to be essential. Yeah, home insurance, auto, that's essential.
Yeah. Okay. How many, Elizabeth, do we have time for any more? Or are we running late here?
I think we have time for one more.
Okay, well then I'll give you this one. Cindy wants to know, what are the pros and cons of a joint account with a partner or spouse? Well, that's a bit of a curveball, Matt. I don't know how you'd answer that. I guess.
Thanks, Mitch. Great last question.
Yeah.
No, it is a good question, and some of it, part of the answer is going to be determined by whether it is a spouse or not. There are different ways you can set up a joint account. One is a joint with rights of survivorship, where if one of you dies, the other gets the account. I think if you're married and you share finances, then setting up a joint with rights of survivorship is usually a great idea. If it's not a spouse, you can set up a joint account with a friend, with anyone. That's when you need to be careful and understand the relationship and whether it makes sense to be sharing an account like that.
Well, then I think we're done. I think we're done with the questions.
Okay. Yeah.
Wonderful.
All right. So sorry, Elizabeth, go ahead.
Go ahead. I was just going to thank you both for being here, but go ahead and close out.
Yeah, no, that's okay. These are just a couple of tips for folks you can look at. Basically, just take these things on one at a time. You have time on your side, all of you, and I really appreciate everyone being here, carving some time out of their Tuesday night to join us. And Elizabeth, thank you for inviting us and making this whole thing happen.
Our pleasure. Well, first of all, congratulations to everyone who won the raffle. As Mitch mentioned, he and his team will be reaching out to those individuals via email to get your information to send the book along. A huge thank you to both Matt and Mitch and the entire Rebalance team for this presentation today, for putting it together, for all of the time and effort that went into it, and to providing such valuable information on how we can all set ourselves up for long-term financial success. I just want to say on behalf of the BU Young Alumni Council and the BU Alumni Association, thank you to everyone who joined us, and a special thank you to all of those who continue to support our students and the university through your ongoing donations. So as we noted in the beginning, a recording of this webinar will be available for on-demand viewing on our website, which can be found at www.bu.edu/alumni. We'll also provide a copy of today's slides for your review and answer any questions that were outstanding in a follow-up email. So if you registered and you joined us this evening, we'll send out all of that information to you shortly. Thank you again for all of those who have joined, and we hope you have a wonderful evening.
Thanks, everybody.
Thank you.